Hello everybody, and welcome to the Quant Investing webinar series, where today I'm going to tell you about the one indicator that can increase your returns an average of just under 211% in the testing we did, up to a maximum of 363. We'll get to that later. Here's what we're going to talk about today: what the indicator is, how it is calculated, what it tells you about the company, how it increased the return of all 13 strategies we tested it with, and exactly how you can implement it in your portfolio with a few simple mouse clicks. And then at the end, there's going to be time for questions and answers. If any time during the presentation you have a question, feel free to type it into the question box. And after the presentation, I'll answer the questions on a first come, first served basis. What is the indicator that I'm talking about? If anybody's read any of my emails or looked at the blog posts that I write, you'll know that it's the Piotroski F-Score. It was developed in the year 2000 by an unknown accounting professor called Joseph Piotroski at the University of Chicago. He wanted to find a way to improve the returns of a simple low price to book value strategy, and developed a 9-point ranking system that basically tells you if a company's financial statement is moving in the right direction. We'll get to that later. The paper was called Value Investing: The Use of Historical Financial Statement Information to Separate Winners from Losers. When I send you the presentation, you'll see that this is a hyperlink, and you can just click on the hyperlink and you'll go to the full presentation or the full paper that he wrote for further information. Before I get to exactly how it's calculated, let's first talk about, did it work? Before we start delving into the technical details, did it work? That's the most important question you always need to ask yourself about anything that anybody's ever tested. Well, it exceeded his most optimistic expectations. Over the 20-year period from 1976 to 1996, a low price to book strategy combined with the best Piotroski F-Score companies outperformed the market an average of 13.4% per year over 20 years. And it gets even better. By buying the best Piotroski F-Score companies and shorting the worst companies with the lowest Piotroski F-Score, that means low price to book value companies with a bad Piotroski F-Score, it outperformed the market 23% per year over the 20-year period. I'm sure you'll agree that's very impressive. Here is a summary. I just included 2 tables from the research paper that shows you. Think about what he did. He first looked for companies that were cheap on a price to book value basis. And then from these companies, he invested in only the best, you can say 8 and 9 Piotroski F-Score companies. On average, these companies returned 13.4%, as you can see in the top red circle. In the bottom red circle is if he invested in the highest Piotroski F-Score companies and shorted the low Piotroski F-Score companies. Here's another interesting table from the research paper that clearly shows that the Piotroski F-Score works best for small companies. That's good news for us because it's companies that big funds or hedge funds can't invest in, but it's the ideal companies for us to look for. In the square block that I drew in red on the table, you'll see those are small companies. But let me just first say these are not necessarily small companies, because he split the universe of US companies into 3 blocks: small, medium, and large, which means this is the bottom third of companies. I couldn't find an exact indicator of how big those companies is, but these companies may even have a market value of $1 billion. Anyway, the small companies, if you buy companies with only a high Piotroski F-Score, the top left circle, you see that returned 17.9%. If you go to the right, for medium-sized companies, it only returned 7.9% better than the market over the 20-year period on average. And for large companies, you can see that the benefit was negligible, only 2% better than the market over the 20-year period on average. But if you invest in high Piotroski F-Score companies and short low Piotroski F-Score companies, you'll see your return from small companies, the tested return from small companies over the period went up 10% to 27%. For medium-sized companies, that was also the case. It went up to 17.3%. But here's a very important point. You can see that the good Piotroski F-Score companies doesn't work for large companies, but avoiding bad Piotroski F-Score companies for large companies is a huge benefit because it went up from 2 to 15%. So even if you invest in large companies, the one thing that you can take away is avoid companies with a bad Piotroski F-Score because those really underperform the market. Let's look at how it's calculated. The Piotroski F-Score is calculated into 3 sections. The first section has got 4 indicators in it, or 4 numbers, and it deals with profitability. The first one, does the company generate any return on its assets? In other words, is its net income before extraordinary items, is it positive? If there is some return on assets, then it scores 1, else it scores a 0. If it's negative, in other words, if the company is making losses. Then does it generate a cash flow return on assets? This is a very simple ratio, taking the operating cash flow from the cash flow statement and dividing it by assets. If it does generate positive cash flow, then it's a positive thing, then it scores 1, otherwise 0. Has there been a positive change or an increase in the return on assets? In other words, it means you compare this year's return on assets on last year's return on assets, and if it went up, in other words, if the company generated a bigger return on its assets, then you score 1, otherwise you score 0. And then what is the quality of earnings? And that he did a simple test. He said, is the cash flow return on assets, in other words, operating cash flow divided by total assets, is it higher than the pre-tax or the net income divided by total assets? This means that cash flow return on assets is higher than net income return on assets. And that's logical because net income return on assets has depreciation included in it, whereas cash flow doesn't. So cash flow must always, except if there's something seriously wrong with the company, that it's making accounting profits but not cash flow profits, it must be positive. So if it does generate a better cash flow return on assets than net income return on assets, then it scores 1, otherwise a 0. The next group of indicators has got a lot to do with funding and looks at the funding of the company. And the first one is, has there been a change in the gearing or the leverage of the company? If the gearing is lower, then it scores a 1. In other words, if its long-term debt to total assets is lower, then it scores a 1, otherwise a 0. Change in working capital. Compare this year's current ratio to last year's current ratio. Current ratio is simply current assets divided by current liabilities. And if the current ratio improved, then it scores 1, otherwise a 0. And change in the number of shares in issue. He took a simple measure saying that if the shares decrease during the year or if they remain the same, then it scores 1, otherwise it scores a 0 if the company had to issue shares. And lastly, he looked at the efficiency of the company. First of all, the first indicator he looked at there was change in the gross margin. Gross margin is gross profits divided by sales. If that went up, then it scores a 1, the company scores a 1, otherwise a 0. Change in the asset turnover, that means does the company generate more sales on its total assets? If it does, then compared to the previous year, then it scores a 1 and then otherwise a 0. And to get the Piotroski F-Score, you simply add the 1s or the 0s of these 9 tests, you can say, together. And a good or high score is an 8 or a 9, and a bad or a low score is a 0 or a 1. This is what we tested. We tested 13 investment strategies over a 12-year period from June 1999 till June 2011. In the left column, you'll see all the different strategies we tested. The next column shows you the standalone return of just that strategy. And the next column shows you the return we generated if we combine that strategy with a healthy Piotroski F-Score. And the last column just shows the improvement of the strategy returns over the 12-year test period. You can see that the best or the most improved strategy was free cash flow yield. Free cash flow yield is simply cash from operations minus capital expenditure divided by enterprise value. If you combine a simple ratio like valuation, like ratio like that, with the Piotroski F-Score, the returns went up more than doubled from 317% to 680%. And at the bottom, if you look at the averages, you'll see that the standalone strategies on average generated a return over the 12 years of 218.1%. And with the Piotroski F-score, it went up to 428%, nearly 100% improvement. As you can see, 210.6%. I'm sure you'll also agree that that's impressive. It's an impressive improvement. How can you add that to get that working in your portfolio? It's very easy to do. If you're a subscriber to the screener, you'll see that this screenshot will make immediate sense to you. You've got 4 primary factors when you start up the screener that you can use. And in the first factor, if you select the Piotroski F-score, it's under the quality headings of ratios and indicators. And then in the range bar, to get the best ranked Piotroski F-score company, simply select 0 to 20%. That will make sure that you only select companies or only search for companies with a Piotroski F-score of 8 or 9. How about companies with an improving F-score? Well, we also have a report for that. 3 times a week, we comb through the database and look at all the companies that have updated their financial statements and compare the F-score of the company 7 days ago to what its F-score is now. And if that increased, the company is added to this report that you can look at on a daily basis. As I said, we update it 3 times a week. Here you can see, for example, in the right red arrow, it says what was the Piotroski F-score 7 days ago and what is it at the moment. You can see all these companies improved. And yet, there's a lot more to this report. It's all in Excel format, which means you can sort it and manipulate it as you want to. There's a lot of valuation numbers to the right of this report, but I only included the F-score numbers to just give you an idea of what it looks like. So in summary, this has been quite a technical presentation, and all these ratios and indicators may be a bit confusing, but it shouldn't really be, because the basic message is that the Piotroski F-score is a great indicator to increase your returns, help you screen out deteriorating companies with bad fundamental momentum. It means that its financial ratios is moving in the wrong direction. It works especially well on small companies, and it increased the return of all the strategies that we tested it with. And here's another benefit that a subscriber to the screener mentioned once, is that I use stop loss based on prices. But if you're more of a value investor or a fundamental investor, you can look at using the Piotroski F-score as a sort of a fundamental stop loss. For example, you keep on looking. In the screener, you can build a watch list of your portfolio, and every now and then, say every month, look at the F-score of all the companies. And if the F-score falls below 6, then you know you've got to take a serious look at this company, or maybe think of even selling it out of your portfolio. That's the end of the presentation today on the Piotroski F-score. If you have any questions, I'll answer them now. I see there's a few questions already typed into the Matt. A bad Piotroski F-score is 0 or 1, and a good one is 8 or 9. I would say if they move close to those numbers, then you should, I wouldn't say be careful, but those are really the cut-off numbers, if you can call them that. I hope I answered your question. Just let me know in the box. How often do we check that? I would say, depending on reporting season, for American companies, you know that they're quarterly reports, so the screener will update those numbers quarterly. For European companies, only half yearly. So I would say if you check on a monthly basis, it's not a very volatile number. So if you check on a monthly basis and just see if the numbers are moving in the right or wrong direction for the companies you have in your portfolio, that would be fine. Matt asked if we should ignore the others. I would say what would be nice in the other values is to see what direction it's moving, if the F-score is increasing or decreasing. But I would say the other numbers are not that critical, but if it moves to, say, 7, 8, 9, those are really good numbers. I generally look for better than 6. And I really avoid companies with a low Piotroski F-score. I wouldn't look at anything at a number lower than 4. Eric has a question saying that the median return with low doesn't mean if you miss one of the stocks, it's going to have a negative return. That's a good question. Let's go back to the table that he's referring to. Eric, what mean value are you referring to? Can you just type it into the chat box? I can't see the number that you're referring to. Oh, for small companies. Sorry, I saw it now. I wouldn't say that, because just have to look at the number of companies in that portfolio. The N number is 895. So I would say, just imagine how far down the line you must buy those companies to get to any value that gets closer to zero. And also, if you look and see that that number is so big, it means that it's highly unlikely. I assume, I can't remember from the paper, but I assume that he had an equal weight portfolio, and it's very unlikely that that any one of those values would have skewed the returns that much. Philip asked an interesting question, saying, is there a F-score for the market of all the companies together? I haven't really looked at that, but I think it'll be more of an individual indicator, because I don't know if he's referring to it in terms of ETF investment, but I don't think you can really say that that is applicable. Mohammed, you started typing a question, but I think I only see 2 words. Can you maybe type it again? Are you talking? Yeah, that's a good question. Because Mohammed asked if it can be used for service companies. I assume that you're asking the question because they may not have a lot of assets. I think it will be, because they still have an extent of assets. And remember that the Piotroski F-score uses a lot of other ratios and indicators. So even if the one is not applicable, the others should be. Matt asked a question if adding the Piotroski F-score will make your returns more or less volatile. Matt, I assume that because you're buying companies, if you only buy companies with a good Piotroski F-score, you're buying companies with improving fundamentals, right? So I would imagine that it'll make your portfolio less volatile, but I'm also, it'll depend on what other indicator you combine it with. If you buy, for example, low free cash flow yield companies with a good Piotroski F-score, I'm sure it'll help you lower the volatility. If you're more of a momentum investor, then you have the normal problems. That momentum is a great indicator because it generally keeps on going. But if it turns around, you have to be quick to stop the losses on that. Nadir asks if momentum will increase the performance of a strategy like this. I do include momentum, Nadir. Just, as a value investor, it took me such a long time to convince myself that momentum is a good indicator to use. But from all the testing we've done and the research that that I've seen on momentum, I'm a complete convert to using momentum in a strategy. So what I use is I use a valuation number. I generally use QI value in the screener. And then I use the Piotroski F-score to get companies with good fundamental momentum. And then I use momentum as a third indicator. So I combine those 3 when I look for investment ideas. I'm sure that the momentum indicator will increase performance. But again, as I mentioned previously, be careful when momentum turns around. That's why I use a trailing stop loss. Matt asked if we'll get a printout of the presentation. Yes, Matt, I'll send you all an email telling you where you can get a recording of this this presentation. And in the same email, the link I'll send you, you can download the presentation as well, and you can view a recording of it. Any further questions? Thank you, everybody. I hope you find the presentation valuable and that it'll increase your returns. Bye-bye.